Hey everyone, Ash here with the Better Than Yesterday blog. Look at you go! You made it to advanced bookkeeping. Okay, you must be a little bit of a nerd, but in a good way. So let's get right to it. First, let's go over cash versus accrual basis. Most startups and small businesses use the cash basis accounting method. Cash basis is simple to understand and easy to implement. However, there are IRS regulations on reporting with the cash basis method. So let's do a quick refresher on the difference between the two. Cash basis means that you record the transaction when it happens, when cash exchanges hands. So for example, you receive a bill on August 15th, but it's not due until September 5th. So you record the transaction when the cash leaves your bank account, which is September 5th in this case. Accrual basis means that you record the transaction when it occurs. So in the same example, you received the bill on August 15th, but it's not due until September 5th. Even though the cash will not leave your bank account until September 5th, you record the transaction on the day you received the bill, August 15th. Most of the reporting that you do in beginner and intermediate bookkeeping is very basic income and expense reporting, with a little balance sheet reporting. By very basic, I mean that you see the transaction on your bank statement and then you report that on your books, with no further consideration of actual values or balances. To show an accurate reflection of the balance sheet and income statement, there are some adjusting journal entries that need to be made. So let's take a look at one that you're familiar with. So we already know that the property and equipment section of the balance sheet has this thing called accumulated depreciation. And the accumulated depreciation is what's going to help show the accurate value of our property and equipment. Okay, so how in the world do we get that accumulated depreciation number, and how does it get in your books since you never wrote a check for it? Well, you use adjusting journal entries. The adjusting journal entry needed to correctly reflect our work vehicle is going to debit the depreciation expense and credit our accumulated depreciation. Many adjusting journal entries involve an income statement account and a balance sheet account. Here's an example of other adjusting journal entries that you may need: allowance for doubtful accounts, change in the market value, accrued expenses, accrued income, prepaid expenses, deferred income, and unearned income. Now let's move on to the third statement that you need to tell the entire financial story of your company: the cash flow statement. The cash flow statement provides details of what happened to the company's cash during a given period. The cash flow statement is broken down into three categories: operating activities, investing activities, and financing activities. The operating activities are basically what's on the income statement, which includes revenue and expenses of a company. So it's pretty much the net income on the income statement. Investing activities show the purchasing or selling of assets. So it's pretty much the property and equipment section of the balance sheet. And financing activities show the debt and equity financing for the company. So in other words, it's the liabilities and equity section of the balance sheet. And after completing the cash flow statement, the cash at end of period balance should match your balance sheet cash and bank account balance at the same given period. Congratulations on moving up to an accurate set of books. Keep it up. Always work on improving yourself and your business to be better than yesterday.